Hello, and thanks for joining me, Warren Jeffrey, for your next lesson in the Accelerated Investor Program. In our last lesson, Francois Jabet explained exactly what explosive growth shares are, and he shared his 3 top tips to identify the best ones to invest in. And we allocated the first 15% of our portfolio to investing in these explosive growth shares. Today, we're going to be taking a closer look at the second component to make up your millionaire mix, the large cap shares on the market, or as they're also known, blue chip shares. You should allocate 15% of your 100,000 Rand, that's 15,000 Rand, to blue chip shares to build your million Rand portfolio. Blue chip shares are the perfect way to build a stable, long-term share foundation to boost your portfolio gains. These shares are such good investments, they're loved by most fund managers and make up the core of most investment fund portfolios. That said, you don't want to rush out there and buy any old large cap share. No, you want to pick only the very best blue chips to add to your million Rand portfolio. And there are 3 factors to consider when deciding if a blue chip share is a quality investment you want to own. 1, its margin of safety. 2, its potential for growth. 3, its potential to generate income. Depending on what your investment goals are, you'll want to focus on finding a blue chip share that delivers one or more of these key benefits. If you're nearing retirement and are going to need some income paid out to you regularly, then you need to consider blue chip income shares. If you're more conservative, then you won't want to take on much risk. So you need to invest in shares that offer you a large margin of safety, also known as value shares. And if you're willing to take on a little more risk for the chance of big rewards, then you want to look at shares offering growth potential. Let's take a look at each type of blue chip share so you can decide which ones are the right ones for you. To start us off, we'll look at how to find the best income blue chip shares. Income blue chip shares must offer a steady stream of income every couple of months. So you need to focus on the company's income payments to find the best income shares to invest in. The income paid by these companies are normally referred to as dividends or distributions. And to see how big these payments are, you want to look at the company's dividend yield. The dividend yield is simply the dividend or the amount paid out by the company each year divided by the share price. The higher this number, the better the income you'll earn on your money. Ideally, a good income share should offer you a dividend yield of more than 5%. To find really good income shares, you want to look for more than just a good dividend yield. You also want to make sure the company has earnings consistency. Simply put, you want to look back at the company's dividend payments over the years and make sure the company has been able to sustain these payments. After all, you don't want to invest in a company that pays a massive dividend this year, only to pay nothing the following year. A great example of a good income share is Vodacom. This company is paying out a great dividend at around 7% and has been steadily increasing its dividend payment for the last 3 years. In 2010, it paid R3.55. In 2011, it paid R5.40, and in 2012, it paid R8.05. You can clearly see how each year you'll be receiving more income from the company. This is what makes a great income share. Now, to invest in the next kind of blue chip share, the kind that will bring you quick investment gains with a high margin of safety, you need to find the company offering you good value for money. In fact, this type of investment is called a value investment. To find a value investment blue chip, you want to find a company that's trading below its fair value. In other words, the profits the company is generating are larger per share than what you'd get from any other large shares on the market. To uncover these value opportunities, you want to invest in shares that have a low PE ratio. Now, you might remember, Francois Jabet touched on this ratio in the last lesson. By comparing the company's share price to the earnings per share, you can find companies that are relatively cheap compared to the market. In general, the lower the PE ratio, the cheaper the share is, and the better value you're getting as an investor. And because you're investing in shares that are already cheap, it's less likely the share price will fall a lot if the market falls. That means these kinds of blue chip share investments are less risky for you as an investor. Some nice examples of value blue chip shares right now include Steinhoff on a PE of 7.7 and Sasol on a PE of 9.8. These shares have PEs well below the market average of 16 and represent good value investments. An important thing to note when you're looking for value blue chip shares is although you want a share with a PE below the market average, a PE that's too low can be a sign something is wrong with the company's ability to generate profits. So rather avoid large cap shares with PEs of less than 4. But what about if you want to bank massive gains? If this is the case and you don't mind a little more risk, then a growth blue chip share is the investment for you. Unlike the income shares that will use profits to pay you the income, or value shares that are underpriced and offer you a cheap investment, growth shares are generally not cheap and don't pay out great dividends. So you're probably wondering why you'd want to own these shares. Well, it's simple really. Growth companies are in businesses or they have products that are likely to expand rapidly. And as these companies grow, you'll be banking more and more profits. So how do you spot these investments? The quickest way is to look for shares that have a higher than average return on equity, or ROE. Now, don't worry, I know this term can sound intimidating, but it's actually really simple. Return on equity is just the amount of money or growth a company returns on the amount of investor capital or equity it has to work with. And the more money a company can generate from the equity it has, the more money it'll generate for you in the future. So, the higher the return on equity, the better the growth investment opportunity for you. Ideally, you want to look for companies with returns on equity of more than 16. This would see the company making a 16% return on the capital employed each year. Again, like with income shares, you don't just want to look at the current return on equity. Rather look at how the company has performed over a couple of years. For example, consider a company like Bidvest. Over the last 5 years, Bidvest's return on equity has been 24.2%, 20.34%, 19.81%, 20.45%, and 20.96%. As you can see, the return on equity rate for Bidvest is consistently high and stable. In fact, if you look at the company's return on equity since 1994, you'll see it's averaged a return on equity of 23.9% over the same period. If you had invested 10,000 Rand back in 1994, it would be worth 290,549 Rand today. As you can see, that's a really great return. And by looking for companies with consistently high return on equity figures, you can be sure you're investing in a company that's likely to deliver massive growth in the future. Now you know what to look for when you select your first blue chip share investment. For income shares, you want to look for blue chip shares with a dividend yield above 5%. If you're looking for a blue chip share that'll deliver quick gains with a high margin of safety, you need to look for a company with a PE lower than the market average and above 4. To find a good growth share, you want to look for a blue chip company with a return on equity above 16%. So use these tips to find the perfect blue chip investment for you. And remember, most companies will not only fit one category, but may have a mix of these characteristics, depending on where they are in their business cycle and how they're moving from one category to another. But the point is to invest in companies most suited to fulfilling your investment needs. So choose your favorite blue chip share and get invested today. If you're unsure which blue chip shares to buy, why not join my private wealth network, the South African Investor? Every month, I help members build real wealth by identifying exactly which blue chip shares to buy. I have 3 specific portfolios built around the best value, growth, and income opportunities on the market today. To get your hands on these low-risk ideas that work and find out more about the South African Investor, simply click on the link at the end of this lesson or look in the resources section of this site. To grow your 100,000 Rand to $1 million, you need to allocate 15% of your money to blue chip shares. When you buy your first blue chip, make sure you don't invest less than 5,000 Rand per share. That's because, like we discussed in step 4 of the Accelerated Investor Program, investing less than this in any one share will mean you pay unnecessarily high brokerage fees. To see which blue chip shares represent the requirements I've outlined above, make sure you check out the resources section of your online classroom. You'll find a list of shares that are good buys right now. Make sure you join me in the next lesson of the Accelerated Investor Program, where we'll be covering how you can diversify your portfolio with property. Until then, here's to staying ahead of the game.